So Aisha, it's back to, let's say, what we saw in the month of September. The US tech stocks are leading the price action. Crude is struggling to stay above $75. China, that comeback trade seems to be, the steam seems to be running out of that China comeback trade. And in general, if one looks at the general positioning of risk, the risk in the world seems to be clearly positioned on the upside rather than on the downside. So it's too early to say that, okay, all the geopolitical concerns are over, nothing is going to come out from the China trade going forward. But for the moment, it appears that there is definitely a degree of calmness. There is a attempt in there is definitely an attempt by traders to start picking up spots of momentum. And if the big market, which is the S&P and Dow, if they are at a record high, that just tells you the positioning of the risk in the world. See, Indian markets have fallen not because of any local factors. They had always fallen because of global factors, which is the China comeback trade, crisis in Middle East, crude spiraling up, and outflows or selling by foreign institutional investors. So a lot of those concerns for the moment are getting addressed. What may actually happen is that the market, which in a sense was just going from strength to strength, and it was enjoying very strong degree of momentum, that momentum surely has faded away. But the fact that we've stopped falling, we've started making a base, global markets are strong and supportive. There is a big departure in where we were a week ago versus where we are. Nobody is talking about kya bechne ka. Everybody is now talking about kya lene ka.
Yeah, absolutely. And, to our benefit, you've seen a bit of an ease off in crude prices as well. They've managed to dip about almost 2% on demand concerns and, of course, Israel's comments as well. Remember, OPEC lowered its outlook for global oil demand growth in 2024 and 2025. And there were also some media reports last evening indicating that Israel is willing to strike Iranian military and not their nuclear oil targets. The reason why you did see that spiral up come in on crude, but now it seems that it's only going to be a military attack, if at all. So you saw crude as well ease off quite a fair bit. But for us, we managed to do quite okay yesterday.
Yes, indeed. We managed to extend those gains in yesterday's trading day to wrap up above the 25,100 mark. So incidentally, we managed to cross the 50 daily moving average, and it was support coming in from a lot of the rate sensitive. So real estate, banks, IT, actually gains coming in across the board. And barring metals, everything closed up in the green. And what was interesting was that the broader markets as well were pretty much in tandem with the frontliners. So the small cap index ended 0.5% higher. 5 straight days on the trot that the small cap index has managed to gain. And the top sectoral gainer was real estate. So clearly it was a pretty solid day on D Street. And Nikunj, going by the fact that we managed to close above the 50 DMA with a lot of support coming in from the banks and rate sensitives.
See, the September low is intact on the market, which means that market surely has found support at lower levels. The selling of FI seems to be reducing. The collateral damage in, let's say, a Reliance and some Adani group of stocks in terms of the price damage, I think in the near term is already over. Small cap stocks, selectively, they've started outperforming. So I think the way I would look at the market right now is that the market is, at least, so you'll have to divide the market in two parts. First, benchmark indices. The benchmark indices are unlikely to do anything special on the upside. However, the downside also seems to be getting protected. Reliance and HDFC Bank, because of FI selling, they in a sense continue to be the bugbear for the market. That's the Nifty for you. But interestingly, at a time when Nifty has led the market decline, or Reliance has led the market decline, small and mid cap stocks selectively are showing signs of comeback. So there are two trades in the market. One, Nifty, where you may not see anything special. B, small and mid cap stocks, so news driven stocks where market reaction would be largely governed by numbers and largely governed by reaction. The pockets where I think that in the near term there could be some excitement, number one of course is metals, because that's the real deal in terms of where the demand is moving and where the China trade is moving. Second, the jury is still not out how the festival demand would move, but it is not as exciting as what it looked last year. So maybe zinc from some of the autos and maybe from the two-wheeler stocks that may start coming out. Third pocket where you could actually see some renewed activity or vigor which actually should start coming back is real estate, because all demand indicators are indicating that there is no slowdown in real estate demand. So that becomes another pocket of strength where you would actually see classic comeback activity. So it's a market where October is going to be different from September. It is a market where you don't buy the news, you don't buy the rumor, you buy the news. Earning season is off to a mixed start, which means the upside momentum will not get generated, but sliver of the market where outperformance would be there. I think those stocks have potential to outperform. So it's not a market where you can say, okay, I'm going to come in and by the evening, I would have I would enjoy the market momentum, benefits of market momentum. It's a market where you will have to pick your spots. The market is going through time-wise and price-wise consolidation. The shakeout has happened. The low-hanging fruits have been plucked, and the weak fruits, which in a sense were there, they have been uprooted.
Oh yeah. Okay, let's take stock of what back home is going to be, keeping you busy, and a lot of earnings. First off, of course, it was Reliance, and inline set of numbers, though the OTC business was largely muted, you'd have to say. So that's definitely something that the street is going to be reacting to. And given that, the weakness has come in for their mainstay business, let's see what the stock actually does today. But largely the numbers were, at par with what the analysts were expecting. The dip in profit, of course, and the OTC performance is something that the street is going to be digesting this morning. There's also Reliance Jio. The ARPUs have come in at a 10-quarter high. There's HCL Technologies, wherein they've upped the lower end of the guidance. And then, of course, in terms of macro data points, you had the CPI print, which has now come in at a 9-month high. So a lot of moving parts, both in terms of earnings and, of course, the macro data point, because CPI is going to be a big one.
So Aisha, let's look at first Reliance, and there's nothing exciting in the Reliance numbers which in a sense will generate upside momentum. So if you look at numbers, all the verticals, whether it is Geo, retail, OTC, there is a visible slowdown there, or the environment continues to be challenging for Reliance. So Reliance now is going through what could be called as a earnings downgrade cycle rather than upgrade cycle. Most of the brokerages who track Reliance, they've downgraded their estimates for Reliance anywhere between 4 to 7% or 7 to 11%, depending on what their estimates were. So price targets have also come down. But interestingly, Reliance has already gone way below 3,000. So the downside reaction to these numbers, I think, is not going to be there. So while these numbers may not warrant a comeback in Reliance, but even though price cuts have come out, even though earnings have disappointed, and this may really be the trend for next 2 more quarters, the downside in the Reliance stock actually could get capped. So I think Reliance is now reaching that level where now downside of more than 4-5% should actually be used to buy into Reliance, because this entire earnings downgrade cycle is something which 2 quarters ago nobody thought was coming. Now I think everybody has acknowledged the fact that this quarter, at least the second half of this year, would be a tough one for Reliance given the cyclicality of the business they currently are in. So I don't expect too much of downside for Reliance this year, purely because it has fallen from 3,000 to levels of 2,700 in a hurry. And the reaction to numbers will not be large, purely because of the collateral damage which has happened.
Okay, so watch out for Reliance Industries. That's going to be a stock that we'll monitor. We will also be watching out then for Hyundai Motor, because they're going to be creating history in the capital markets, the biggest ever IPO this week after LIC. And given that it's the second largest passenger vehicle maker, it's going to be important to watch out for very impressive anchor investors, marquee names, financials robust, and the second largest in the PV market share.
The sheer size and the brand, and perhaps then auto companies of that size is going public, is exciting enough. So there are 2 parts to it. One, is Hyundai more like a classic compounder which you want to bet on for next 3 to 5 years? The answer to that may be yes, because they are India's second largest auto company. They really understand innovation. They have margins which are in the top pedigree, and they in a sense have really maintained their leadership, number 2 in some categories, number 1 in some categories, and the range of products what they have now, it clearly means that Hyundai is getting completely future ready. The second part is that will this IPO, looking at the market conditions and the pure size, will this be like a rara listing like what we've seen with Bajaj Finance and others? The answer to that may well be no. A, the size is large. B, the market conditions are different. And C, in terms of sheer attractiveness of the price, the attractiveness of the price is not so exciting that it's going to be a great gap up start. Also, the sector is going through a cyclical slowdown. If this issue would have come a year ago, then it would have really become the talk of the town. So A, there is a headwind in the sector. B, the size is large. C, this is a sector where you pretty much know that in the near term, because exciting things will not happen, so the gap up start will not be there. So the issue will sail through. If you have a 2-3 year time frame, well, it could give you market beating returns. But at the current level, if the valuations are to be compared with the industry, it is at a mild discount, but that is not exciting enough for a 50% gap up start.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 1,865 to Rs 1,960 per equity share of face value of Rs 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, BRLMs and the stock exchanges.